Welcome to Module 4, Section 6, where I'll talk about an interesting topic known as the magic of compounding. Many of you watching this may have heard of the power of compounding, where you can take a little bit of money and turn it into a lot of money just through the magic of compounding. Taking advantage of compounding can be very powerful. Albert Einstein is credited with making the following quote: "Compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it." Now, if he really said that or not, I'm not quite sure. But he is credited with making that statement. Let's go through some definitions about compounding. Compounding involves reinvesting profits. Now, you can also add additional money, but just if you take your profits and reinvest them, that can have a real powerful effect. Profits can be interest. Those of you that have bonds, you're earning interest every month, every quarter, every year. Instead of taking that as income, you use that money to reinvest into the bond. The same is true with stocks. Some stocks pay dividends. These are profits that the company makes and they pass on to shareholders. Instead of taking that as income, you use those dividends to purchase more stock. And capital gains. If you buy a stock at 10 and sell it at 20, you have a 10-point profit. Instead of taking that and putting it in your bank account, you use those capital gains to reinvest and purchase more stock. Rather than keeping this money, you reinvest it. Over time, this can make small profits turn into very large overall returns. So what I'll do now is go through some theoretical compounding. Please understand this is theoretical. It's not realistic. The idea behind this video is just to show you the power of compounding, not the reality of compounding. The key to compounding depends on a number of variables. The first variable is how much do you invest? $100, $1,000, $10,000? You'll start out with a set amount. Also, the rate of return, 5%, 10%, 20%, whatever figure you want to use in your compounding. This is the real key, how often the value is compounded. If you take a set of money, let's say $1,000, and it earns 5%, if you compound that 4 times, you'll get a result. But if you compound that 10 times, you'll get a much greater result. Here's an example. If you take $1,000 and you invest that, and it earns 20% in 1 year. Now, 20% is a real high rate of return. Even with the stock market doing really well, a lot of people are not seeing 20% returns, although they are possible. There are different strategies that you can implement that generate weekly, monthly, quarterly, and annual income in addition to capital gains that allow you to have a really nice rate of return. Sometimes that can be as high as 20%. Sometimes it may be as low as 5 or 10%. Sometimes you may even have a negative return. That's why this video is about an idealistic or theoretical possibility. It's not realistic. After 1 year, the value of that $1,000 would grow to $1,200. The $200 is reinvested in year 2. So instead of taking that and using that money, you put that money back into your investments. In year 2, if another 20% return is achieved, the value would grow to $1,440. And that's with your initial $1,000. You haven't even added anything additional to that. This can be repeated over and over and over. That's the idea behind compounding. The greater the amount, so $1,000 would be much greater than $100. The greater the rate of return, 10% will earn you much more than 5%. And the greater the number of compounding periods, compound this 4 times instead of 1 time, the faster the final amount will grow. So you need all 3 of these variables together. So let's go through some theoretical compounding examples. As stated earlier, $1,000 after 1 year with a 20% return would grow to $1,200. If the original amount is compounded on a quarterly basis, so 4 times each year, the value would grow to $2,073.60. Not bad. That's over a 200% return. If the original amount is compounded on a monthly basis, or 12 times, that amount would grow to almost $9,000. 900% return in 1 year. Very unrealistic, but with compounding, theoretically possible. If the original amount is on a bi-weekly basis, so every other week, and we'll figure 52 weeks in 1 year, so half of that would be 26 weeks, the value would grow to over $114,000. If the original amount is compounded on a weekly basis, so 52 times, the value would grow to over $13 million in 1 year. The one thing to be aware of, over the years, there are a lot of people who teach programs about investing, and one person in particular really got a hold of this concept and used it as a marketing tool and just said, well, we're just going to earn 20% every month. And you let that compound 52 times, you're going to be $13 million richer. That person ended up going to prison, not just for that reason, but for a lot of other reasons. So now let's look at the reality of compounding. As can be seen, the numbers can become huge over a short period of time, such as 1 year. Yes, theoretically, you could take $1,000 and turn it into $13 million in 1 year. You need an awful lot of things to go right in order for that to happen, and you need it to go right every time, without any losses. This seems too good to be true, and in fact, it is. The reality is that many things prevent the theoretical example from becoming real, and this can include 20% returns are not always realistic. A lot of people just seek 7% a year. They use the rule of 72, which is how long it would take for your money to double, and using that rule, it would take about 11 years. Historical periods have shown that the S&P 500 gets about 10% each year. Now that can be a little bit misleading because you might have 10% as the average, but 1 year may be up 30% and the next year is down 20%. Plus the emotions that are involved in such wide swings. It almost makes it impossible to experience consistent returns of 10% each year. Also, one loss can wipe out most, if not all, profits. You might be going along in your 52 times that you compound things, and you get to 51, and all of a sudden you're wrong and everything gets wiped out. You have a really high success rate, you have a really good rate of return before that investment occurred. With you putting everything on the line like that, if something goes wrong, everything can be wiped out immediately. As the amount grows, it becomes unmanageable. If you get up a spreadsheet, which is what I'm going to go to here in a minute, and you look at week number 36, and you're going, oh yeah, this week I would have just put this amount in and I would have got this much back. Think of what you're going through at that time. You don't manage $1,000 the same way that you manage $10,000. As much as you may apply mental analysis, fundamental analysis, and technical analysis, you get caught up in the amounts that you're dealing with, and it becomes really hard to manage very large amounts of money. The trade sizes become too large, even for something like the S&P 500, which is the most liquid investment available. If you're starting to do millions of dollars of trades back and forth, you're going to get noticed, and it's going to be hard for you to get in and get out. In one of the other videos, I talk about we have advantages that the big guys don't have, because we're like a small speedboat that can zip into a position and zip out, where they're like a big cargo ship, where they have to turn slowly and they have to plan well ahead of time what direction they're going to take. Well, if you start getting into the markets and have huge amounts that you're managing, now you've become one of those big cargo ships. And then fear and greed are almost impossible to overcome. If you start with $1,000 and you see that grow to $20,000, $30,000, $40,000, $50,000, you're going to go crazy. Yeah, it's nice to have success. It's nice to have good trades that occur in the markets. But something happens to you over a period of time and you start to change your personality. What worked for you when they were smaller amounts, now you're thinking differently, and that may not work as you're dealing with larger amounts. Another thing to consider is that positions require round values. In order to achieve these types of returns, you have to implement things like options. Well, options are based on 100 shares. And when you're buying a stock, you need to buy 100 shares or 200 share lots. When you're dealing with dollars and cents, that will not always equal out to an even number of shares, either 100, 200, 300. So some of that money will not get reinvested because it doesn't buy a full lot or it doesn't cover a full options contract. For example, it may not be possible to invest $1,234.68. Amounts must fit the position amount and size in order to use lots and standardized option contracts. We're not using dollar cost averaging here, where you take a set amount and you may be able to buy fractional shares or a fractional lot or an odd lot. Let's look at a little bit more realistic approach. And this is just one example that I give you. There are lots of different money management techniques and ways that you can take advantage of compounding, but be realistic at the same time. A plan should be developed that includes proper money management. That's really what it's going to come down to. One example that you can implement may be, instead of compounding 52 times, use dollar amounts as plateaus of achievement. You start with $1,000. If it grows to $10,000, you take out $9,000 and place this amount in other, less risky trades or investments. So let's say you have an income producing strategy, and that's turning out income every week, every month, every quarter, and so forth. Once that amount grows to, let's say, $10,000, you start over again. You take out the $9,000 of profit, put it somewhere else where it's not at risk, and now you can start over again with the $1,000. Another approach could be that you want to protect your initial investment. You start with $1,000. Once it grows to $2,000, you pull your $1,000 out and put that in a safe place. Now you're starting again with profits that are already earned. You're not using your own money to try to get those returns, and you're not putting your own money at risk. Yes, it is your money, but it's not money that you've actually sacrificed to put into the market. These are profits that you've already generated. Then repeat the process starting with $1,000. Now, even that is quite unrealistic, but this is much more sober than just thinking, I'm going to start with a small amount, have it grow to a huge amount, and everything's going to be fine along the way. It's not going to be fine along the way. The gains will not be as great, but they're still very good. Just think of it. If you can take $1,000 and after 1 year have it grow to $2,000, that's 100% return in 1 year. There aren't any banks that are paying that. There aren't any dividend-paying stocks or interest-bearing bonds that are paying that kind of interest. What I want to show you is just a spreadsheet that I created relatively quickly, where I just plugged in a bunch of numbers. I don't take into account odd lots or round numbers, but I just want to show you the power of compounding. If we start with $1,000, and after 1 year we get some remarkable 20% return, for year 2, that then gives us $1,200 to invest, and then we just keep repeating that over and over. If you compound that 4 times, your amount will grow to over $2,000. So you've more than doubled your money. If you compounded that once a month or 12 times, it would grow to almost $9,000. If you compounded that every other week or bi-weekly, that amount would grow to over $114,000. And then, as I talked about earlier, if you compounded that 52 times, that would grow to over $13 million in 1 year. So let's play around with this a little bit. Instead of earning 20%, let's go down and say that we just earn 10%. Okay? That is a good rate of return and nothing to be laughed at. The numbers will be smaller, but they'll still be very significant. If you compound $1,000 4 times, that will grow to over $1,400. 12 times to over $3,000. 26 times to almost $12,000. And then 52 times would compound to $142,000. That would be very good, respectable returns and almost off the charts as far as calculating your rate of return for the entire process. So let's get even a little more realistic and just say 5%. I remember growing up in the 1970s, we would have our little financial classes in school, and they would say, okay, take amount of money, $10, $100, and then compound it at your savings account rate, And we always used to use just 5%. That was the given rate. Well, now 5% would be seen as a really good rate of return because interest rates are so low. Well, back in the 70s, 5% was really low because we were in times of ultra high inflation or hyperinflation. And 5%, you were actually losing money because the inflation rate was at 10, 15, 20% at times. Nevertheless, let's just look at 5%. After 1 year, that would grow to $1,050. Nothing to brag about, nothing to write home about, nothing to retire on. After 4 times, that would grow to a little bit over $1,200. 12 times, almost $1,800. 26 times, $3,500. And then the whopping 52 times, it would grow to over $12,000. So really a good rate of return even at 5%. The idea is we're using the number of compounding periods to our advantage. Our interest rate, 5%, would be high in today's terms, but historically would not be unrealistic. The challenge would be, could you do this 52 times in a row? That becomes the real obstacle at that point. Let's go back and try 15%. If the average rate of return of the S&P 500 is 10% and you think you can do better than that, let's say you can average about 15% a year. You'd be pretty much a rock star if you could, but let's just see what would happen in that case. So at 15%, you compound that 4 times, it would grow to over $1,700. 12 times would grow to over $5,000. 26 times, almost $38,000. And after 52 times, things would grow to about $1.4 million. Really good returns. So I hope this helps you to understand just the power of compounding itself. I have this spreadsheet available. If any of you want that, please contact me. I can email it to you. It's not all that difficult to set up if you know how to work with spreadsheets, but I just plugged in all the formulas and then let the numbers recalculate as they need to. This concludes Module 4, Section 6, and I'll pick up with things again in Module 5, Section 1.